is Linda Raschke. Synopsis. Linda is president of LBR Group, CTA, and LBR Asset Management. Has been a full-time professional trader for 33 years. Linda has been recognized in Zach Schwager's New Market Research, and her hedge fund has been ranked 17th out of 4,500 in total for the best 5-year performance by Barclay Hedge. Linda has presented her research and lectured on trading for the Managed Futures Association, the IFTA, Bloomberg, MTA, and has been president of the American Association of Technical Analysts, as well as serving on the board of directors of the Market Technicians Association for many years. Linda loves charts, horses, and music, but not necessarily in that order. The topic of her presentation is 3 time-tested systems that are durable and robust, pros and cons. So without further ado, Linda.
The main thing is get the main idea right, all right? Above all, as technicians and so forth, our job is to get the main idea right, and that can carry us a long ways, you know, without worrying too much about the precise entry, precise exits, you know, micromanaging things and so forth. You know, there's really a lot to be said about get the main idea right, so much as work that Nelson was presenting you based on simplest of economic trends, yields, so forth and so forth. And then the other theme that I hope that you got out of his presentation was it's durable and it's robust. It's held up, it stood the test of time, bull markets, bear markets, it wasn't overly complicated modeling. It didn't matter if you used a 50-week moving average or a 55-week moving average, et cetera, et cetera. So that's very, very important when we start looking at a little bit more aggressive timing techniques in quantitative modeling and so forth. You know, I've had the good fortune of doing a lot of work over the years and research over the years with some good partnerships, people that are far more skilled at eye than, you know, in being able to do things with the computer and so forth. You know, I can tell them what to do and they can make it do it. So, you know, far more skilled people than I to do all the research, you know, but throughout the years, I've found that my best models, the best things that I incorporate into my work tend to have no more than 2 or 3 variables at the most, okay? 2 variables and 1 filter, and you can go a long ways with that. I also have the good fortune, my husband, Damon Paplatos, his original partner, has also founded GetGo. Now he runs a firm, Future Path Trading, which also caters to a lot of black box and high frequency stuff. And being in Chicago, I'm very close to a lot of prop shops and quant stuff that's being done. And I don't think people quite realize that most of this stuff is not holding up, or it's an overly crowded field, something that might have worked a particular ARB situation a year and a half ago, no longer works now. It's very difficult to come up with, you know, your own little printing machine like everybody would like to fantasize about, so you can go sit, you know, coconuts on the beach. You know, it just doesn't quite work that way, which, on the other hand, you should take heart in, because the purpose of this organization, MTA, technical analysis, okay? So on one hand, I want to present you some ideas that I feel are important to model, you know, departure points for your own work. Yes, they can serve the basis as mechanical systems. I'll actually show you some that we have incorporated into our program at periods. But on the other hand, I do want you to believe that humans and our discretion actually can have an edge, okay, over this field that's overly glorified, I feel, this quant field a little bit, you know, that Andrew Lowe, you know, himself has presented work that shows that humans are far better at pattern recognition than computers are. And I'll give you some examples of that. And ultimately, where the money is going to be made, it is in the management strategies, your trade management strategies, all right? That's ultimately where the money is going to be made. And as you just saw a brilliant example with Nelson's work when he took a model and just simply made it to go to 2-to-1 leverage, right? Okay? It really comes down to the leverage part of the equation when you are actually trading or managing monies too. You know, there might be certain times where unique opportunities where it demands a little bit more commitment on our part. And those don't come that often. You know, those certain points where the risk reward is skewed in that type of extreme just does not happen that often, nor is it something that a computer or an algorithm can easily recognize. All right? But computers can. So, I mean, excuse me, humans can. So you do have an edge. You have more of an edge than you might think, and our undoing of that edge comes from our overthinking things, varying our consistency in what we do way too much, not staying consistent in one field rather, you know, and of course the emotional dilemma as well. I'm sure at some of the points where Nelson in his work was showing you to do a certain allocation might not have been the easiest times, you know, economically or whatever, you know, or you might feel you're too late or you're getting in at a bad time or whatever the case may be. You know, so that is the importance for me of coming up with models. And then I can trade around the models and work around these models. But like I said, I think you'll find that some of them have, you know, departure points as well. First of all, I just have to summarize 4 main points that I found that 99% of our work that is durable and robust is built around one of these principles, and you probably know them already, but I feel it's my moral duty to brainwash you with them as well. And that is simply back to the days of Charles Dow. Trends have greater odds of continuation than reversal. Why are you spending so much time looking for mean reversion strategies and so forth? It's like it's a piece of cake. You know, the trend has greater odds of continuation than reversal. Some things about trends, most trends tend to end in a climax. If you've studied some of Soros's tenets, you know, he'll say that markets don't stop at an equilibrium level or a neutral level. Price tends to way overshoot. So you'll see that sometimes, even though it might be 80% late into the trend, there's still like the bulk of the gains to be made as you get that last parabolic move. And that's some of the modeling that I've tried to capture in more recent 6 years is this outlier or this fat tails or these aberrations, which in my work show far more frequently than we would expect, okay? So if you have some type of bent towards trend following, even though it's not what I do with my firm, and I'll tell you why, but it's still, there's a lot to be milked from that very basic premise, okay? The second thing, momentum precedes price. Okay, that's like, duh, that's when an oscillator makes new high, and then price high is yet to come, and so forth. There's a lot of systematic work that can be done around that. The flip side of the coin is A, in very noisy data, it's a tough game. Momentum models can be particularly noisy. And B, it's not necessarily going to put you in a position of capturing that big win, all right? Which in what our modeling and what we do with our trade management strategies is we'll look at, does it model out for a small win or a small target? Can you play for a big target? Or can you trail a stop type of thing? So for example, if you're looking at a simple bull flag type of formation here, that's not necessarily going to test out best trailing a stop just because you enter on a bull flag. Because a lot of times the bull flags might happen after you're already pretty well marked up, you see? But that could still go into the category of momentum things. So trends end in a climax, I mentioned that. And lastly, market alternates between range expansion and range contraction. That's the premise of volatility breakout systems, which still do very well today. So I'll get into a little bit more of each. Obvious trends, greater odds of continuation than reversal. This was Apple. I put that up there because I thought it was pretty humorous that from this point, 540, it still went up to 700, you see? So whoever thought it would go up to 700 from here? And then whoever thought it would go back down to 400, you know? That's what I have to say. I've been trading for full time now for almost 34 years. And it's just a classic adage that the longer you've been in the markets, you know how little you know. And you know, it's just our ability to predict or forecast, in my book, is about a big fat zero. You know, I can never say how far something's going to go. And it always will exceed, you know, what I'm thinking. Same thing too. What I'm going to go through today is I'm going to show you the process by which we categorize structure, market structure, and everything I do is off of an average true range function. I found that preferable to like standard deviation functions or percentage functions or something like that. By the way, I hope you can see right away that I'm trying to like make up for, I'm going to razzle and dazzle you, giving you far too much information. I understand that, okay? So far too much information, you can write all this down, but there's a lot of things I thought I would want to share with you. And by the way, I am presenting a whole weekend of this stuff this coming weekend. If you're interested if I'm not presenting enough ideas today to you, I can give you a whole weekend's worth this weekend along with my husband. At any rate, what I will show you though is structure and a way that we can quantify trend reversals and go through a process which you'll see, I think will support all the things that you probably know intuitively. I think that everybody here knows the basics of technical analysis and Wyckoff's process of a reaction up and an automatic retest and formation of base and so forth. I think you know that intuitively, but we'll find a way that we can put it into a concrete structure. So trends very, very seldom go straight down and straight up. There's a process, a basing process, or a topping process, or a lot of rotation, if you will, before it reverses. And this is a classic case. I just took a stock here, Starbucks. At the time, you can see the range expansion at the top. That's actually pretty common as supply gets less and less, or same thing for a downtrend, that you do see increase in average true range, at least in commodities, okay? In commodities to the upside at tops, you'll see a huge increase in average true range. At the bottoms, because there's more supply sitting on the market, you actually tend to have a contraction in range. And of course, in the stock market, fear's the dominant factor at bottoms, and we'll often see the increase in range at bottoms as well. But anyway, once again, here Starbucks traded up to 60. From this top here, it ended up coming all the way back down here. You would not be able to extrapolate that at all from this type of chart. It doesn't look like there was any logical point at that time. 43, and now, of course, it's gone from 43. By the way, this was just last year. This was just last year. We went from there down to here, and now, instead of 60, we're up at 74. Okay, so again, quit putting targets on stuff. I've just found that nobody can sit there and put targets on stuff and where it'll go to. Now, simple with momentum and price, the basic today is that you can teach your eye to see this without oscillators and derivatives of price. But the last downswing greater than the previous downstream, a simple proxy for increase in momentum. And then you get your retest function. So this is what I was saying with a type of momentum strategy, not a breakout strategy, not a trend following, but a simple momentum retracement. You'll see that it models out best playing for a small target. Okay, it's not something you necessarily, yes, maybe 1 out of every 20 trades you can trail a stop on and still have a huge win. But when I do my modeling, I'm usually looking at 300 trades, 1,000 trades, block of 5 years and then another block of 5 years, and I want to see the behavior stay the same across multiple markets, because it's got to be a really robust concept for me. So if I do this 3,000 times, it's always going to model out a momentum trade. You're trading for a retest type of function. It may go further, it may not. But it does have a high win rate, which makes it appealing for short-term traders. You can usually get a high win-loss rate with that type of strategy. And then if you wanted to simply add another layer on this is the weekly charts, and you can see the same thing, the increase in momentum by the pullback, and then still up. And we're going to look at the structure recently, which I thought is pretty cool because I did it before the market started rebounding, and see a pretty neat process. But length of the swing is correlated to momentum until, of course, you get that loss of momentum up at the top. And so far, this is just a little bit of a foundation before I take you a bit deeper. Volatility breakout systems, just to give you a little bit of, my evolution as a trader. I started trading volatility breakout systems back in 1991. And keep in mind that the decade of the 80s, I was on the trading floor where we're used to providing liquidity. In other words, I'm against the order flow. Somebody comes into the pit and says, make me a market on something. Well, they want to buy because everything's going higher, and so of course I have to sell to them and then figure out how to scramble so I don't get run over by a freight train. Okay, that was like 10 years of trying to figure out how to arbitrage or hedge so that I didn't get mowed over as a freight train because I was the liquidity provider. So when I left the floor, I had to do an about face, and I'm like, gosh darn it, I'm so tired of losing money, 2 days out of the month and giving back 3 weeks worth of profit, when you're against a strong trend and trending, which happens when you're, the market maker. And so I started trading this volatility breakout system, which taught me some invaluable things that were not intuitive to me at the time, and that was the power of the range expansion, after you've had some contraction, and playing for the follow-through. So that was, since that period, we've traded a dozen variations of it, and you'll see that, as Nelson said, it really doesn't matter, what parameters you use. You'll capture that big win when it comes along. When gold breaks, $80 or whatever, and you're there for that day, you'll find that probably 4 days out of the year will make about 70% of your profits on a system like that. So it's a beautiful exercise. Takes a lot of patience if you're an individual trader trading something like that. Still holds up over time, but the principles based on this contraction, range expansion, and more often than not, you get a little bit of follow through the next day type of thing. So the problem with this system, if you're running large sums of money, is that you're trying to get in the door or out the door with everybody else. So you start to get a lot of friction, meaning slippage in these types of commission systems and so forth. But they still hold up over time just because you've got that principle of forming a value area or an equilibrium point. You get your markup phase. This is a chart of silver, so forth, and that sets the stage for a lot of things. So, and then lastly, once you've done your markup phase, you get that rotation. So then we can take this down to when we start to fine-tune work on modeling or quantitative modeling, it becomes ever increasingly important to define the environment that you're in. Are you in one of those markup phases, okay, or have you just had a large standard deviation move, in which case you might be a little bit more lucky playing a regression to the mean type of system. And once again, humans can actually still do that faster than a computer. A computer will need more bars to have a confidence factor that you've entered into that environment than a human. So, just to sum up quickly, some basic systems. If you want to be sitting on that beach, drinking out of a coconut and letting that printing press do all the work for you, and by the way, I do have friends that are very large CTAs or hedge fund managers that do 100% systematic, and it's exactly like Nelson said. I mean, they've got 20 to 2,000 models running 24/7 on every global market, every time frame, and so forth. Just so ridiculously diversified. I don't think it's a game that the majority of people can play, have that kind of luxury and that type of infrastructure to support that. Okay, otherwise the risks are trend following systems still hold up. They still model out fine. I think they always will. You do need a long time horizon. You need about a 10-year time horizon to have this rolling window. I can take any 10-year period, and trend following systems will have made money. But with that said, they can easily have 2 or 3 years losing in a row. They easily can have 40% drawdowns. The drawdowns on them can be much steeper than I can tolerate. But it's still a very successful quantitative model to follow or use as a departure point. And the people that I see it do it well have been able to adjust that trade management side, usually using a little bit shorter duration or taking half off after, you know, n number of standard deviations and so forth. So trend following systems, volatility breakout systems, I mentioned before, they will always hold up because you know what? They're going to capture that outlier. And so where we're going to go to in the second half of this talk is I want to show you some of the work I've done in positioning ourselves to be capturing a possible outlier, or what I like to call extended run or larger trend type of move. The momentum strategies, I think that every discretionary day trader loves these types of things, doing the little retracement trades, you know, when you've had already the market's tipped its hand, you've had that shift in supply demand, there's some good movement, you've seen the volume come in, yeah, get that little reaction and you're playing for that retest. I mean, that's just a slam dunk little trade. It's not a big win. You're not going to get wildly rich doing it, but you can steadily improve your bottom line. Now, reversion to the mean, I'm not a big fan of. I'll just use an example for you of some modeling that we did just testing out a simple momentum divergence, okay, which you would think leads to reversion to mean type of thing, simply playing back to a moving average. And the modeling was interesting because we look at how many bars of data does it take before you retrace back to that moving average, and as well as you know, what's your ATR win and so forth and so forth. So just to sum up for you, a reversion to the mean, just simple type of thing. We did not use any stops. We always use modeling without stops as our departure point, and then just simply look for like how long did it take to retrace to a moving average. And in general, it had a win rate that was pretty darn impressive, about 76%. That's pretty decent for just a mechanical model with no stop. And you know, the exit was when it hit that moving average. It took about 4 bars for it to retrace to that moving average. So your wins had a relatively short holding time, okay? Relatively short duration there. I think your average win was something like 0.8 ATRs. You know, it wasn't a huge win. So you've got that model of, you know, high occurrence, high frequency of trading activity. The trades that didn't lose, I mean, it didn't win, that other 20%. A losing trade had an average excursion of 25 bars against you before it retraced to that moving average, as well as 5 ATRs against you before it then retraced to the mean, okay? So obviously nobody's going to do that. But what I'm saying is I'm making a point here that if you trade that type of approach, you need to have something work right away. In other words, you need to have a time stop, all right? And the trades that go wrong can go horribly wrong. So your personal money management skills become increasingly important. And obviously, you're getting slammed by what we're going to model next, which is those outliers, those trend moves, those extended runs. Obviously, when you're first finishing up with the trading range, you know, you can still get that last little trade that you think you're going to be a little divergence at the top of the range, and yet it could get blasted and run over. So my point is that this type of strategy can go horribly wrong and cause huge losses, and I'm sure everybody's been there where it looks like it's a divergence or a sell divergence, which all happen naturally in trending markets, right? Everybody knows that, you know, that non-confirmation, but wait, but it's still going against, well, I'll just give it one more day. Oh wait, well, I'll just give it a couple more bars. And you just start getting yourself into a big hole. So I'd rather be on the flip side of that. I don't know about you guys, but I'd rather be positioning myself to capture that, and that's where I want to go. Now just a couple more things about basic technical analysis, because I really want to keep drawing people back to classic technical analysis, because there's so much value in it that I think gets swamped by all the gobbledygook out there. Seriously, there is so much noise and junk and Fibonacci and Gann, and then it's not that it doesn't have value for you, because it might help you personally put stuff into a framework, but somehow I just have a very difficult time seeing Paul Tudor Jones using Fibonacci to manage money, okay? It doesn't work out that way. So, you know, all this stuff has value because you're making it your own little universe and world. Is it statistically significant? No. But so what? Who cares? If it works for you, use it. But this type of stuff that we look at here, I think, is something that everybody can see, and that's what makes it so powerful. When you just look at the basic bar charts, and you've got your swing highs and your swing lows, everybody sees the same thing. So you've got, this has been going on hundreds of years, your sideways lines. Charles Dow put that out, your sideways lines. Price rotates around a central value numerous times, right? Okay, this is what creates our chart formations, just basic chart formations. And we all know that basic breakouts from chart formations are a good idea. That's a valuable idea, okay? So breakouts from sideways lines are one of the things that can lead to a bigger win, or what I call an extended run. This is what I want to model if I'm a trader. This is what I want to capture, because I don't know about you guys, but I don't want to be sitting there making 50 day trades a day, and I don't want to be, you know, grinding it, you know, forever. But I would like to at least put myself in a position of having better odds of seeing something like that. Okay, here's a simple pullback right here, and this is exactly why I said the simple pullbacks model out playing for small wins only. Sometimes it will give you a big win, but sometimes not. So they actually model out just playing for a little piece. But that little ABC, which we can quantify, and I'll show you how, actually also sets up one of the spots where you can play for a bigger win. I call it a power buy, you can call it an ABC, a more complex correction. Okay, these are good things. And everything else is pretty self-explanatory until you get to the top and you see the sideways lines there. Couple other things of importance. This is the only formation that led to a big win, which was a counter trend trade, okay? And that is this concept of converging trend lines, ascending or descending wedge. Classic technical analysis. You must have 5 data points, all right? 5 data points. I am not saying anything new, because all of this was laid down 100 years ago. 100 years ago in the books of technical analysis. So 5 data points is the only counter trend spot where you may get a big win. So we've got simple retracements, more complex retracements, and already you can start to see how everybody in the marketplace sees the swing highs and swing lows. That's where we want to know how the volume is. That's where the market psychology orients itself. And then once again, the sideways lines. And you can start to block off the chart formations and the trading ranges and put up simple rules or structures such as, you know, push back, push up outside of that, and you start to come back down beneath it. What is your target? The middle of the range, just like a market profile value area concept. And if you can't hold the value area, the middle of that range, you're going to test the lower end of the range. So we can start to add some constructs. Now, just so that you never think it's that easy, what is the nemesis for systems, for most traders, and so forth? I should say most systems, but the market enters these periods of noise, okay? Noise levels actually in the last number of years have increased, okay? This is all built on Perry Kaufman's work. I think he made a comment that the more mature a market is, the higher the noise level. It starts to increase. In other words, if you don't want noise and you want a totally efficient type of move, go find new emerging markets, okay, and you'll start to eliminate that noise. Also, the lower the time frames that you go down to, you get an increase in noise. Well, guess what? This is a weekly chart. This is a weekly chart of the Russell going back 8 years here. So Weekly data also can be very noisy. And why is this so difficult? Okay, it's so difficult because here you're thinking upside breakout, buy the retracement. No, it's just a price rejection spike. You know, that's pretty obnoxious, price rejection spikes on weekly data. All right? Same thing to the downside here. Doesn't look like any rhyme or reason. However, if you were to take your ruler and draw one big sideways line, you have a giant value area, which is why, okay, when we started that move up after 2000, this was incredibly strong. So again, that law of alternation, once you've done this huge noisy rotation market, the trends that come out of this are more powerful than ever. So let's get down to some brass tacks and tools by which we can start quantifying things so that we at least have a framework or structure. Wave structure, again, how many of you have ever read or looked at Art Merrill's early work called Filtered Waves? Okay. It should be on the reading list for the MTA CMT exam. If it's not, there's not a whole lot to read, but it's the concept that he classified the structure of bull market tops and bear market bottoms in the Dow going back a couple decades based on the swings. And he used percent functions, percent swings. No surprise that this man had an engineering background, right? Okay. So that's a very common thing now incorporated into a lot of software packages. You know, if you have your package, it can plot percent swings. It can plot, I just like to do them on average true range. And this formula that I use was actually put out there by Wells Wilder in his book, Advanced Concepts in Technical Trading, that I think he published 24 years ago. I tell you guys, there's nothing sacred out there. There's no secrets. Everything's already been published. I'm just regurgitating somebody else's work, you know? So what we've got here are these waves, and what I'm going to show you is where the sweet spot in the data is in our modeling. Okay, where that sweet spot is, that's the home run piece of data, where your risk reward is going to be wildly skewed in your favor. And here you can see you've got an uptrend, higher highs and higher lows, right? Basic technical analysis uptrend. And we have a lower high and a lower low. But we all know that's not a trend reversal yet. It could just be a simple ABC correction down, right? Because we know that trend reversals actually come from two lower highs or two higher lows. Again, that was put out there years ago. Wyckoff preached that too. So what happens is that at this point, when you've got this ABC in your data, right here, you've got a sweet spot where we've got greater potential for a big win to the upside or great potential for a trend reversal, which can lead to a big win to the downside. What made this work? Why does this work? Because you've had an increased duration with which prices rotated around the central value, right? And we know that the longer that think about market profile, you know, the bigger the node, the longer those value areas and stuff. Once you move out of that, all right, you've caught more people off upward side. It's going to create the potential for a stronger trend. So let's see what this actually looks like there in the slides. You know, you can, as Nelson mentioned, it doesn't matter if you use 2.5 or 3. Doesn't matter if you use 9, 14, 20. See, it shouldn't matter the parameters that you use. All you're going to be doing is just filtering or tweaking the noise levels, all right? I like to use the lowest low of the bar. I do believe Wells Wilder, when he published this, actually used the close of the bar. Doesn't matter. Does not matter. So here's what it looks like now. I just plotted this on TradeStation for you, and actually I can do this on CQG, TradeStation. You can do it on just about any software program. But you can see now that this is plotting the swings up and down. I don't know if it's too faint for you or not, but the see a little thin red line here, okay? This is the ATR function plotted just as you would plot a parabolic stop. I'm sure everybody's seen what a parabolic looks like on your charts, and or any type of stop and reverse type of function, so that I know once price hits that stop, okay, now I'm in a downswing. So you can only plot the swing after you have hit the opposite side. But you can see, first of all, that it helps support visually, okay, these waves. Because you've got an ATR function, you're eliminating a lot of the noise, a lot of the little wiggles and jiggles. We can go down to lower time frames if we want the little wiggles and jiggles, okay? But our idea, remember, our whole idea is to get the main idea right. We don't want to get tripped up in noise. We're not trying to trade micromanage every little jiggle of the swing. We want the main idea and the main waves right. And by the way, this is weekly data. So just eyeball how nice and clean weekly data is. Now, I printed this when we were retracing back, I think it was about 2 weeks ago, and you can see we pulled down off that high, and the weekly charts had been down for a couple bars, all right? It hadn't been down enough to plot a downswing yet, but we were definitely correcting a little bit on that. So here we go down to the daily chart, and now you can see the red line there. We hadn't pulled back down off that high. It just shows up better on the daily data. But overall, we're still in an uptrend, right? We've been in an uptrend on the weeklies. We've been in an uptrend on the dailies because we don't have that succession of 2 lower highs. I mean, here we had a pullback, but we went up and made a higher high. So we still have that nice uptrending channel. And actually, it wasn't until I go down to the hourly charts, where you can see where we were 2 weeks ago. Finally, in the hourly charts, I had 2 lower highs. The lower lows take it out. And we were in a downtrend on the hourly charts. So when you are modeling or when you are trading, you're not just trading the S&Ps, or you're not just trading the bonds, or you're not just trading gold. You're trading the S&P 5-minute chart, or the gold hourly chart, or the bond daily chart. Each time frame could be considered to be a different market, you see? So you could have a downtrend on the 5-minute bonds while the weekly uptrend was still in an uptrend. Why is that so important? Because your time frame is by which you're going to measure your risk. Okay, so the time frame is going to dictate your risk because obviously your ATR functions, which is what I like to use for risk. I like to know how many ATRs I'm going to risk, you know. They're obviously going to be much smaller ATRs or smaller risk functions on a lower time frame. So first of all, the number one lesson is if you're a newer trader, you certainly don't want to start off by trying to do your trading on daily and weekly charts and try to figure out where to put your stop there because you might not have enough capital to sustain that. You know, you're better to go down to a little bit lower time frame where it's manageable. And then ultimately, of course, the long end goal is to use the lower time frames for your initial trade location, because that becomes increasingly important when you are using leverage as your trade location, as well as monitoring your risk. But playing for the potential of that higher time frame, playing for the luxury or that big win that could come from that higher time frame, turning its swing back up. This is a 15-minute chart, so now I just dissected even further, and I thought this would be a nice little exercise so you can see the way this unfolded. We just had weekly uptrend, daily uptrend. We're in a corrective wave down on the daily chart. This was as of 2 weeks ago. The hourly's had a little bit of a downtrending channel. Now I'll just go down to a 15-minute chart. And what do you see right away? Okay, this is very important when you're doing your, if you are into system development, is that the noise levels jumped up a lot, right? It's not so pretty like that weekly chart was. It's not so easy to see these gorgeous waves and patterns. It's a bunch of junk up there, a bunch of gobbledygook. So the noise level on the lower time frames is much higher, which for some traders is something that trips them up. They start over trading without a clear idea as to what their game plan or roadmap is. But on the other hand, you can see here, we've been in a downtrending channel here. This was just a big ABC up. Remember, ABC is a good shorting spot. That's a great shorting spot in a downtrend. And here we have another ABC, okay? So let's just see how this unfolded for fun. Now what I did is I actually made the bars turn red and green, as well as these little things. At first I just wanted you to concentrate on the swings, but you see we can make the bars do the same thing too. And you can see that this was the little ABC that we were just looking at before. It came down and it tested, and we had yet another test. And now on that 15-minute time frame, what do we have? For the first time, a trend reversal. The lower time frames always do a trend reversal before the higher time frames. Well, of course, because they're a lot noisy. What does that tell you too? It's like it takes a long time, a very long time, to turn a weekly uptrend to a downtrend. Maybe at least a year and a half. So the market environment that we've been in has had a weekly uptrend on the charts, no lower high, on multiple global indices. So just keep that in mind. Where we are now, I'm not saying that we're going to continue up forever or whatever the case may be, but it's going to take a long time, a long process of back and forth and one lower high and a second lower high on the weekly charts before this whole thing rolls over. Probably at least a year and a half, in my opinion. So now we've got the 15-minute charts finally have an uptrend. You've got your ideal risk-reward point. I've got the uptrend here on the 15-minute chart. I've got all the potential for that daily chart to pull back up and so forth and so forth. And trust me, they'll always come out with some little convenient news or reason why the market did what it did after the fact. But I'll tell you, the technical underpinnings are right there. So just to show you again on a 5-minute chart, that trend reversal process, because it's pretty important, because this is something that was laid down 100 years ago, and it still holds up. And you can see one higher low, two higher lows. So I always think of it as taking out the high of an ABC up. And if you wanted to, you just put a buy stop there and see what you get. As we'll see the trade management part of the equation is going to come into play a lot. But, so does everybody see that trend reversal process, first of all? One higher low, two higher low. Seriously, because I'll tell you a story, I'll admit. I had been a floor trader for 10 years, and I had a buddy who wasn't a floor trader, but he did a lot of work for me. And his name was Dan Chesler, and he said, hey, I think we had joined the MTA up in New York just to, have some excursions and stuff, get away from the floor environment. Because, let's take our CMT exam, okay? This is like when it just first started written up, I'm like, CMT, what the hell? Why would I want to do that, I'm like, I'm a trader, So, no, come on. So they gave you the little reading list and stuff like that. Honestly, now, I've been a full-time professional trader for 10 years, and here's the question. What defines a trend? Okay, what's the classic definition for a trend? And I would be the first to admit that I would not know this answer properly if I had not read it in the study guide literature, okay? Because seriously, is it like, well, the moving averages are going up, the moving averages are going down. What is the pure definition of a trend? And strictly in technical analysis, it's like a higher high and a higher low, and you really need at least two higher lows. And then you can say that you've got a trend. So enough of that. Let's just, I don't want to spend a lot of time, but I just marked off the spots where we make trades to have initial bias, because what you can't do as a trader and what you can't do in a system is to trade every little wiggle and jiggle, okay? But something needs to have a basis for the trade. You need to have a basis for your trade. My basis for a trade is I need either better odds of a big win or better odds of a winning trade, another high percentage win, as opposed to just having a trade, okay? So random entry. We do a lot of modeling with random entries and so forth and so forth. So I wouldn't want to be looking to short this type of thing, okay? I don't want to try shorting this because it's just bad risk reward. It's got low odds of a percent win and low odds that it would be a decent trade anyway. So I'm not going to be looking to short this. I'm only going to be looking for the long trade there. Same thing here. I don't have enough substance to think that I'm going to short, even though it might look like a double top type of thing or a failure up there. It's just that our modeling won't let us do that. This is a very aggressive trade, that 4. It is one of the 5 trades that we can make. It's called a failure test, okay? Failure test where you actually fail to take out that high. And again, technical analysis. What defines support? What defines resistance? You need 2 data points, right? You can't call something resistance with 1 data point. You have to have 2. It has to be tested, right? So these basic foundation, you know, this basic premise that all of us are part of these technical organizations to brainwash ourselves, really, it serves a purpose. So here you have a failure test, okay? That is an aggressive trade, but it's still the trade that we can take because we have very well-defined risk. And then here you actually had another failure trade here, see? And 5 actually was a breakout from a wedge, or where is it? Oh, this is the trend reversal process. Let's see, 5, breakout from converging trend lines. Okay, so that was our wedge type of trade. When you've got the breakout from the converging trend lines, then you can actually take a counter trend trade as well. So this is just to give you an idea, simple retracements along the way. Here's your ABC down. I didn't mark off every single point. This would be a trade that we would actually trail a stop on because this ABC could lead to a bigger win. These were just small add-ons or small scalp type of things. So we can actually come up with a structure. And like I said, I don't want to glamorize it that it's so easy because you can hit pockets of these noise environments too. That definitely adds a challenge to the trading. So I picked a classic case, the Boons, the 700 tick chart. I love trading the Boons because they are the most liquid, deepest market, you know, with wonderful movement to trade. And so I just picked a tick chart here. It's actually the equivalent of about a 120-minute time frame. And just so that you can see, again, the failure tests. And by the way, when we model this, you can't buy that low. I can't buy that low there. I have to have something like it takes out the green line and comes up, you know, or else you're using a lower time frame to enter into that. So I always have to assume that my initial trade location is going to be less than ideal. Okay, allow for a lot of error, a big window on your entries. Then if you can do better than that, that's great, you know? You can do better than that. But one thing that we tend to do when we look at our modeling or our work is kind of do a little sneaky data mining on the sly. Well, if I had entered here, you know, that type of thinking. And don't let yourself go there. That's why I have to say, well, the computer would have entered here, you know? And that's why also it's important if you're doing work like trend following work, allow for a period of decay. Well, if I had to enter 24 hours later than when my signal was given, would I have any deterioration in my system? Extremely important if you're trading with a long time horizon. I don't want 80% of the gains to be front-ended there on that first breakout bar. Also, I want to come up with strategies where I can do size. I may not be able to get a decent position on in 1 hour time frame. I might need to work it over a number of hours. So lots of things to think about when we make that translation from the academic world to the real world that involves execution and issues like liquidity Is there liquidity to get out if it's a bad trade? So these are all the things that somebody was talking, was it Nelson talking about a balanced life or something? Or maybe I was convincing up there with some friends, you know, about having a balanced life where we could, you know, go out and enjoy the quality of life. And like, you know, by doing other activities. I'm like, no. You don't get it. This doesn't work. It's great. You know, like we all enjoy doing this, right? We all enjoy doing this. It's fun. Yeah. So, okay. But anyway, my point is that these converging trend lines, very important. You know, once again, 5 data points. You need those 5 data points in technical analysis. And I use my entries from something that I learned from Perry Kaufman. Okay. Was it Perry Kaufman or? No, actually it was another friend. I steal all my work from other people, you see. I always take the best of their ideas and see, okay, somebody else did all the initial groundwork, okay? And now let me see how I can incorporate it. But never enter on breaks of ascending or descending trend lines, because their risk is that there's still too much noise. Always force it to take out the horizontal line, you see? Force it to take out the swing low, not just the slanty trend line. So you see here, even here, you're in a very strong downtrend after this downside break. This is an ABC. If the computer says use really good leverage here on this, because this is a nice little trap. A nice little trap. So lastly, I just wanted to also show you how you can apply these things down to the shortest of time frames as a discretionary trader, and it'll keep yourself out of trouble. Because I tell you, I don't know about you guys, but me, my losses always come from doing something dumb, you know, like, oh, you know, this is just, you know, too far, too fast. I think we'll have a little reaction up, you know, and you just make a trade that was a stupid trade. It's like there wasn't really a technical basis for it. So these rules will keep you from doing stupid trades. So this was just an S&P 100 tick chart, which is about, this is about the equivalent of a 5-minute time frame, all right? And you can see we're in this downtrend, and there's no reason whatsoever to initiate from the long side. You know, here, not here, not here. There's no reason to initiate to the downside. This is just a one time frame. Until here, you've got this 1, 2, 3, 4, 5. At least I've got some converging trend lines and 5 data points. It didn't give us very much, though, did it? See, a lot of times that's how these things are as well. Sometimes the market just gives you a little bit. You manage it best you can. And we actually had an ABC up. This was a good sell. It said sell, you know, in big size here, even though like you're already down so low, because this could have still led to a whole other leg down, but it didn't. It actually gave you those converging trend lines again. So you get to see how there's a process here where there's always can be a logical point in the data for you to make a trading decision that the computer would agree with. See, that's what I like, that the computer would agree with. Now I'm going to just take a step back, okay, because I want to go back to this concept of these chart formations. And we actually do, at periods, do some type of trend following, but I also want you to understand that I still think that humans can do far better at pattern recognition than the computer. And I want you to see the pros and cons of both. First of all, everybody can see that, again, 5 data points, chart formation, it's obvious, and low ADX. So I simply used, for our program, big chart formation, converging trend lines, low ADX. In other words, there had to be enough duration there to cause that little ADX to drop low, because this simply is based on price bar overlap, right? This is one of the very few indicators that you can use that's not calculated off of closing price. It's simply a moving average of the highs and the moving average of the lows. So when you get a lot of price bar overlap, your ADX drops way down low. So here we've got our breakout bar, and we're going to start to notice a couple things. If it's a good trade, it'll be a big breakout bar, obviously breakaway gaps, so forth. And it makes it very easy just to stick a stop right on the other side, trail a stop. It looks so easy in hindsight, right? So we could actually make a living doing this strategy, but there are a couple problems with it. A, your frequency of occurrence. Right, your frequency of occurrence here, I might get 2 trades per market per year. And that doesn't mean either one of them are going to be successful either. So I got a low frequency of occurrence. And I mean, here's another nice winning trade. It's, you had your low ADX. Remember, we have to make it take out the 20-day low there or that swing low. And the other thing I wanted to remind people of is that when you do have these converging trend lines, we cannot predict the direction of a breakout either. Just always remember that. You can have a downside breakout from what might appear to be an descending wedge. Likewise, if you have an ascending wedge, it's a low volatility point, we can still have an upside breakout. So do keep that in mind. And it gave you a little piece here. And then the problem is that there's always lots of period in the data, had a little in there, but the noise level can increase around these points as well, where you get false trades and false breakouts, and you just need to understand that. That's why these things only have a win rate of less than 50%. But if I had to say, take one KISS method and do it, this is about the simplest that you can revert down to. And the other tricky thing is that I know that most of you have studied hundreds of charts, thousands of charts. And you have to understand that that is a huge edge. Experience is a huge edge. It counts for a lot. It's very difficult to teach a computer some of these things. So for example, this gorgeous little chart formation up here, take a ruler, horizontal ruler, draw a sideways line, and you got your equilibrium point, right? So I can teach you to see that in the charts. I can teach you to see that, and of course, you do have a low ADX here, right? Sometimes the computers have a difficult time drawing trend lines on formations that get sloppier like this. But it's a chart formation where you have the converging trend lines and that equilibrium point, even though it may not be classically recognized as a triangle or so forth. And here you can see you've got the little small triangle, leads to a little look down. You know, depending on how you manage that trade, maybe you made a little bit of money. But over time, you get to see that classic adage that Ralph Campora, I heard him mention once, that the bigger the base, the higher into space. And the broader the top, the bigger the drop. So, ultimately, you can see this was a pretty big, broad base that we built up, and classic signs of a trend, volatility gets switched. The strongest trends have the smallest bars and the narrowest retracements. Very efficient, methodical moves. And I always say that the sign of a strong trend is that there are no patterns. There's no swings, there's no oscillating patterns, very few retracements. You never want to be on the wrong side of what I call a creeper trend. Never, 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 never. And this is why it's important. You see these white bars here. Actually, this is from a different strategy. If you want to know, it's actually a very seductive, lovely strategy where these are reversion to the mean type of points. These are low volatility, loss of momentum, but slightly overbought points where we can make counter-turn trades. Okay, it's a different thing that I'm not going to get into now. But what I want to show you is it's going to get blown out of the water in a trending environment. Momentum, divergences, non-confirmation, whatever. Throw all that stuff out the window once you hit these types of spots. Okay, I've still got a little bit of time to move on to the good stuff. I think I've just been warming you up here, right? You guys don't know me. I didn't even have any coffee before speaking here. I can keep you guys here for 4 hours. You can be my prisoners. Have dinner brought in. Okay. Defining outliers, the extended run. We started off by looking at what can we really call an aberration in the data. okay? This is important because these things sneak up on you, and I want to know when, when does it become likely that we can have one of these runs of 20 closes on one side, 20 up closes or something like that. The types of things that, if you're a trader, you often want to stick your nose into way too soon, thinking that that trend has gone too far too fast, okay? So we used a 5-period simple moving average in our modeling, but as Nelson said, you can use a 4-period, 6-period, doesn't really matter. It'll still be the same type of work. But we used a 5-period simple moving average, all right? And we found that it was statistically significant in our book once you had 7 closes on one side of that 5 SMA. That was significant, that it might lead to an outlier type of run. And every market that we looked at, we usually lose like 26 different markets. They had frequency of occurrence of about 9 to 14 times a year they would hit one of these little pockets, okay? And I'm going to show you what it looks like. And every single market, this is really important, every single market had at least 26 closes on one side of the 5 SMA at one point, okay? This is you can model like a 5 years block, 10-year block, this type of thing, and it didn't change, never changed. So we can have some fun with this and just creating little trading models. I love this stuff. So just to give you an idea of what it looks like, this is the spiders, a SPY. It's actually kind of equivalent to the pit session S&P. I just used this data here. And you can see we had 1, 2, 3, 4, 5, 6, 7, 8. 8 closes on one side of the 5 SMA before we actually had to close back above. So we first started asking the question of, well, what if we short that first close back above and then just cover on a close below? Pretty basic little model. I would always say the computer shorted on the close. I might wait till the next day. Not always. But the computer shorted on the close and it covered on the close the next day. So we don't use stops. We're just trying to look at tendencies and see, is this a viable method? Same thing here. This is a good one. You bought on the close and sold on the close there. And at the bottom, this is really kind of cool too. I just plotted the difference between a 5-period and a 1-period moving average, so you know that's a sneaky little trick. So you can see 1, 2, 3, 4, 5, the number of bars that it actually closed on one side. Whoops. All right. So you get the idea of what that was. And this is just some of the markets that we test and stuff. And these were just some really basic things. What I like to do is I like to say, okay, what if I did this on, what if I did this little retracement trade on the 7th close, on the 8th close, on the 9th close, on the 10th close, right? So I just modeled some basic little windows. And you can see that as long as it was 7, 8, 9, 10, 14 closes on one side of the 5 SMA, you still had a nice little positive expectation there. I mean, not every market worked out perfectly at every data point, but there's some merit to that idea of a nice little retracement trade. And you can see what happens after you've been up 20, 21, 22 closes on one side of the 5 SMA. The results drop way off. You're just getting too late in that trend. It's like, okay, you missed the first bull flag, you missed the second bull flag. Now that the S&Ps have run up 20 points, let's buy this first 1-point retracement, right? I'm sure you've seen people do that. So you have to be careful about that. So this gives some more examples here on crude, and it's just to get the basic idea. Here was one that didn't work. The computer shorted there. And it covered there. So we'll just take that little basic model.
So that time frame is daily, is this?
This is all daily work, okay?
Did you try it in lower time frames?
No, and the reason is because I want to get the main idea right for that day, okay? That's the premise of all my trading and a lot of our work, okay? The majority of time, most markets will trade from low to high or high to low for the day. And then we can start doing sequential work. Okay, for example, you know, there's a lot of systems out there. Okay, beans have been down 5 days in a row, 5 beans on the 5th day, you know, then exit back, like Toby Cravel type of work, and, you know, Niederhofer. A lot of people like to do that type of modeling. I'm not a huge fan of doing that in general, okay, just because of the risk of outliers and fat tails. So usually, I mean, we actually did trade some of this 100% mechanic, but we do it because we're also trading volatility breakout systems, stuff that would mitigate if there were an unusual event in the opposite direction. So that's the way that this stuff would work best if you were just blindly doing it. But like I said, as a discretionary trader, I just want to say, oh, okay, I've got potential for a retracement back down. We'll actually look at what that looks like on the intraday data. So I'm just going to take you through a little evolution here. Okay, see, this is what I first wanted to prevent against. I mean, how much richer would all of us be if we just eliminated our largest losing trade? Seriously, you know what I mean? Seriously, just eliminate your 1 or 2 big boners from last year, and you'd be so much richer. So we want to start off with what absolutely should we not be doing here, okay? Because it's very tempting. You see, this is the DAX. Oh, God. Oh, maybe we've gone far enough. Oh, look, we're starting to test. Oh, nice little double bottom here. We're still in the extended run. And then you buy like 3 or 4 days too soon, and it just throws everything off kilter, you know? So we found that there are definite patterns that form at the bottoms, you know, this little retracement type of thing. At least it's going to keep you out of trouble. It keeps me out of trouble. Like, don't stick your nose in there, Linda. You know, it's just not ripe yet, you know. And same thing even here with wheat. Yes, you could have been a genius and sold that top up there, but that's not where the real gravy was. The real gravy was after it did this little retracement process. And we actually have another little pattern up there that we trade this 3-bar triangle breakouts from, and it caught that nice downside move. So let me just take this as a progression. This is just kind of fun work. You'll see where I'm ending up. So the first part of that was, is there a little retracement trade there? Okay, it's just a little fun thing. You're not going to get rich with that type of trading. And the second trade was, well, what happens if I go with that move? What happens if I enter in the direction of the trend on day 7 and exit 5, 6, 7, 8, 9 days later? That should be a given, right? So these were some examples of what that looked like. I think this was, I don't know, 10 days, okay? How many of you would have felt comfortable selling on the close of that 10th day down? No, it's too oversold, you know, something like that. But selling it there and it covers there. It was a marginal trade. But here was another one. If you shorted on the close there, after you've been down 10 days, and it covered there. So it tells us something that a lot of times our mind just can't see or can't imagine how far these trends or these moves can go. You know, it's easy to visualize things in a range because we have swing highs and swing lows to mark things. And even in the basic starts of a trend, we can look at things like measured moves, you know, or equal length swings, or little tricks like that. Or you can even go into advanced point and figure analysis, you know, and have that big top, you know, top, and then do the point and figure count to the downside, right? But I'm willing to bet that maybe 1% of the people in this room do that. Okay, seriously? So we still need tools to help us deal with these outliers in the data that we just don't see that often and keep us from getting caught on them. So here's just some more. This was like nat gas, you know, entering on day 6, exiting on day 6. There was a long trade and you exited. Here was a short trade and you exited. Another short trade and you exited. And like Nelson was pointing out, doesn't matter, 6, 7, 8, 9. Let's look at the grid. This was taking our little basket of markets, and if we entered on day 7, okay, and exited 6, 7, 8, 9, 10, you can see this is a very robust concept because it's very profitable on anything. What is most interesting is that if you catch a tiger by the tail, don't let him go. Because a winning trade, once you're in a winning trade, you wanted to stay with that as long as possible. If I held till day 10, even though my percent win could go down, even though I might have some give back, on balance, no matter what day that I entered, on balance, it really paid to stay with the trend for longer duration and not get out too soon. So that was a very eye-opener to me in my work. Now look what happens here. Can definitely make a case on this day 18 or day 19 not to get too acute entering too late into that trend. Okay, so I wanted to see, well, what happens? Maybe I can actually go in the opposite direction of that trend. So maybe after I've had 26 closes on one side of the moving average, see? I mean, look at this. How sweet is that? How nice would that be to put yourself in a position to capture part of that? All right, well, we're going to get there. We're going to get there. But let's say I said, okay, after n number of closes, if it didn't test out to go in the direction of the trend, maybe I can try doing the opposite. You know, you'll see, so I said, okay, what if I entered on the first close back above the 5 SMA counter trend trade? And here was another one too. You can see the S&P cash index, okay, to 23 closes on one side was just too extreme. Okay. So here's just simply entering on the other side and exiting. Day 1, day 2, day 3, day 4. You're not going to get rich doing counter trend trades by any means, but at least it said, you know, to mind your P's and Q's, and there might be a little bit stronger reaction to the upside, right? So this is some of our modeling that we have fun with. I actually want to come back to this, but I want to show you now the conditions that tend to precede these extended runs, right? Like, you've been teasing us. You've been teaching us like, little retracement trade where just 1 or 2 days, you know, on a retracement trade, you know, or entering after the move is well mature. But seriously, how do we position ourselves to be on the right side of one of these things? Because you can't see them coming. You know, it's not like they don't ring the dinner bell and say, hey, everybody hop on board, all right? But what we did is, it's a little bit more awkward to program with a computer, even though we're pretty good at programming n number of waves back. We're pretty darn good. But we printed off every single market, every single extended run on the daily charts, and then going back down to the 120 to 40-minute data, because I like to trade the minor movement. I like to trade that 2 to 3 day swing. So at the very least, I don't want to be on the wrong side of that. And then even with that time frame, we'll see spots in the data where we get those bigger wins. Now, what you see here in the charts, this green, red, green, is just what we talked about in the very beginning, plotting that ATR function. That's what turns the swings up or down. I just didn't plot the little dotted lines on here now because we've graduated from that. So the computer can still categorize all these things just by the basis of that red, green, red. So we printed off notebooks of these things going back years, categorizing every single condition that preceded is to see if we could kind of group them into some basic categories. And we could. There's about 6 really recognizable patterns that will precede this. And coincidentally, you know, and this is kind of fun because I was reading Gartley's book again. Sometimes I'll pull an old book out and look for ideas or words or so forth, because I'm not so good at words myself. And he was going over just the basic chart formations that led to trends. And so all of this has been written about before. So this was a Dow extended run. And same thing where you saw those multiple closes on one side of the 5 SMA. This is a 120-minute chart. But all this red data, this was the data in those charts where we saw that trend reversal on the hourlies, remember, where we had the two lower highs? And then we got this extended run. And this is the type of data that I want to be confident that if I'm on the right side of, I can stay with. And so here's one of the conditions that preceded this was just that break from the sideways line. And of course, you can see, I don't have a pointer, but if you look at the green bars right there, relative to the green bars there, that was one lower high, right? And then two lower high with the green bars, if I was plotting those nice little waves. So we actually had a trend reversal point here that additionally had the power of that break from that sideways line. So that technically, this evolved from that trend reversal point. And not only that, we also can look and get ideas of what we need for confirmation. So always two things serve as confirmation on breakouts. Number one, volume. Okay, you should all know that. Volume or range expansion. And then lastly, an increase in momentum. So you had your new price lows and your new oscillator lows. And once again, new price lows and even more extreme new momentum lows. And now you can play your momentum game, right? Momentum precedes price. That strong downside momentum from the breakout is going to give us a little flag formation, you see, that we can expect some continuation. Very, very nice and seductive. And you still know here we've got a good short sale spot, right? Because it's that first green wave up in that downtrending environment. You got to retest down, put the trade on in management, and we actually did go down and retest, actually bounced around here quite a lot. So you can see these trades are always going to have the best potential.
Thank you very much.
You bet.